Welcome back to the deep dive. Today, we are jumping straight into Citigroup's Q3 2025 earnings results. Definitely one of the most watched calls this quarter, not just for the raw numbers, but, for that whole complex strategic story underneath. So, our mission today, give you the fastest way to get smart on this. We've looked at the results, the management commentary, all those tricky accounting notes, and we're going to cut through it all to figure out three things. One, what really drove this double beat? Two, how's that big simplification strategy actually doing? And three, what's the updated outlook mean for capital returns next year?
Yeah, the market reaction kind of told the story right away, didn't it? It was very positive. The stock jumped because, look, this is all about finding the signal in the noise. It wasn't just a simple beat. The market seems to be saying, okay, we're seeing some confidence here, confidence that management is, executing on the strategy, even with some messy accounting stuff clouding the headlines.
Okay, let's unpack that signal then, starting with the headline numbers. It was a strong beat, yes, but we need to be clear what we're looking at. The official GAAP EPS, that came in at $1.86. That's the technical number. But the street, they were really focused on the adjusted EPS, $2.24.
And that adjusted figure, stripping out those one-off costs, that blew past what analysts expected. It really showed the core business is performing well. Revenues were strong, too, $22.1 billion. Also beat expectations. That's a pretty solid 9% jump from last year.
Right, and here's where it gets really interesting for anyone tracking Citi's turnaround story. Profitability.
Absolutely. The adjusted return on tangible common equity, ROTCE, that's the key metric investors watch for banks, right? It hit 9.7% for the quarter. Getting to 9.7% for Citi, that's huge. It really gives some validation that they're actually moving towards those medium-term goals that have been under the microscope for, years.
And they're definitely not holding back on returning value as they build it. They were incredibly aggressive, weren't they?
Oh, yeah. Returned about $6.1 billion this quarter through buybacks and dividends, which, if you compare it to their earnings, works out to a payout ratio of like 176%. So they're really leaning on that big $20 billion buyback program.
Okay, but before we dive into the divisions, we have to talk about that noise you mentioned, the difference between GAAP and adjusted.
Right, exactly. So the results included this one-off charge, $726 million. And that's tied directly to selling off part of their Mexican consumer bank, Banamex. That's precisely why the market, correctly, I think, zeroed in on the adjusted $2.24 EPS. They look past the GAAP number to see the underlying health.
That distinction is crucial. Okay, so let's look under the hood. Where did all that revenue growth actually come from? The institutional side looked really strong. Markets division, that was an absolute powerhouse.
It really was. Markets revenue hit a record $5.6 billion. That's up 17% year over year. Management even called it the best Q3 ever for trading. You saw high activity, especially in rates and currencies. And importantly, prime balances were up 44% year over year. That tells you institutional clients were active, they're engaged, they're parking more assets there.
Okay, but what about investment banking? We heard optimism there too. Banking revenue overall surged 34%.
Yes, and investment banking fees specifically, which have been pretty slow for a while, they were up a solid 17%. The story behind the number is maybe even more important. Management talked about a real revival in deal making. M&A, ECM, DCM, they felt it was fueled by rising CEO confidence around the world. If that holds, that's a good sign for the whole industry pipeline, potentially.
All right, shifting over to the consumer side then, U.S. personal banking, USPB, that showed amazing consistency, right? 12th straight quarter of positive operating leverage. That's quite a run.
It is. Real discipline there. USPB revenue hit a record $5.3 billion, and the ROTCE in that division was over 14.5% this quarter. It kind of shows the benefit of targeted investment. They highlighted momentum from new products like the Citi Strata Elite Card. So even while simplifying the overall bank, they can still grow and innovate in key consumer areas.
Okay, let's drill down into the real foundation, the balance sheet basics.
Right.
Net interest income, NII.
Yeah, NII was up a solid 11.8% year over year, came in at $14.9 billion.
That really speaks to the core banking functions being healthy, doesn't it?
It does. And you saw loans up 1.2% from the last quarter, deposits up 1.9%. Now, those aren't like explosive growth numbers, but they show stability, steady strategic growth. And that's really important while they're juggling this massive, complex restructuring.
Speaking of complexity, Banamex. Nothing seems more complex than that simplification path. Management gave some needed clarity, right? Sold a 25% stake for $2.3 billion. And now they're pivoting the rest towards an IPO, a public listing. The market's really struggled to price this in.
Okay, yeah, this is probably the most crucial point from the call for anyone thinking long term. So let's slow down here for a second. The cash upfront from the stake sale, that's nice, sure. But the real prize, the capital treasure chest, is tied to eventually releasing the risk-weighted assets, the RWA, linked to Banamex.
Okay, explain RWA simply for us. Why is $37 billion of RWA such a big deal?
Right. Think of RWA as basically capital the bank has to hold by law against certain assets considered risky. It's capital that's essentially tied up, it's stuck, can't be used for buybacks, can't be used for new lending easily. Selling Banamex eventually lets them untie that $37 billion knot. Management confirmed it. When Banamex is fully deconsolidated, they expect to release a massive $37 billion in associated RWA. That $37 billion is future firepower, future capital they can deploy. It completely changes the math on their shareholder return plans.
Got it. So the RWA release is the big long-term win. But what about that $9 billion CTA thing, cumulative translation adjustment? That hits the P&L? Sounds kind of scary.
Yeah, it sounds scary because it's a big number hitting the income statement. But management really stressed this. While that CTA, roughly $9 billion, will flow through the P&L, it's basically just an accounting entry. It comes from past currency exchange rate differences. They expect it to be capital neutral in the end. The real capital story, they confirmed, is all about freeing up that $37 billion block of RWA. That's what makes the balance sheet way more efficient.
Okay, that clarity helps a lot. Let's shift gears now from structural finance to the future engine, tech and efficiency. Some pretty wild numbers on AI productivity.
This was my favorite part, actually. They said enterprise-wide Gen AI tools are now freeing up something like 100,000 developer hours per week. I mean, just think about that. That's like freeing up almost 5 million hours a year. That's a huge chunk of an IT workforce. And it's not just talk. They're seeing real measurable lift right now.
And it's not just capacity, right? It's quality, too. They mentioned AI doing automated CRAN reviews over 1 million times this year already.
Yeah, exactly. Speed, quality, security. And this tech focus feeds right into their big transformation program. Management said over 2/3 of those firm-wide programs are now at or near their target state. That includes major improvements in risk and controls, like deploying preventative controls for large payments, which is critical when you move $1.3 trillion daily across 85 countries. You need that framework solid.
And the tech talk went beyond internal stuff too, didn't it? To the future of institutional finance, that whole tokenized deposits versus stablecoins debate.
Yeah, that was a fascinating bit. Management was pretty explicit.
Yeah.
They see tokenized deposits as the real killer app for their big institutional clients. Why? Because they offer real-time settlement, low friction, and they do it in a regulated way. Stablecoins, they're popular, but they come with compliance headaches, tax questions, regulatory fog that big institutions kind of want to avoid. Tokenized deposits offer digital efficiency within a framework they trust.
And they're putting their money where their mouth is, integrating Citi token services.
They are, integrating it with their 2047 USD clearing platform. That's going to enable seamless real-time transactions for over 250 institutions connected to it. It's a big, concrete step to lead institutional finance into that digital asset future.
Okay, so connecting all this strategy and operational strength back to the outlook, the strong quarter meant they raised full-year guidance.
Yep. Full-year net interest income growth now expected around 5.5%. And total full-year revenue now expected to top $84 billion. So both the quality and quantity of earnings are looking better.
And the capital position still looks really strong, CET1 ratio at 13.2%.
Right. And they confirmed they're aiming for a standardized CET1 ratio closer to 12.8%. That includes a healthy 100 basis point management buffer. The message there is pretty clear. They feel they have excess capital, and they're going to keep buying back shares aggressively under that $20 billion program to get down to that more efficient target level.
And those medium-term profit goals we talked about earlier.
They're making them more concrete. Management is explicitly targeting that ROTCE of 10% to 11% for next year, driven by the simplification, driven by the AI efficiency push. They also expect the efficiency ratio, how much it costs to earn a dollar, to drop below 60% coming out of 2026. This is the roadmap they promised, and they flagged their investor day in May 2026 as the place they'll give more detail on the path beyond that 10-11% mark.
Okay, lastly, the macro picture. What was the vibe there? Cautiously optimistic.
Yeah, I'd say that, sir. Management sees the global economy as surprisingly resilient. They specifically called out the strength of the U.S. consumer still, and also all the investment pouring into AI and data centers as key economic supports. But despite that relative optimism, they stress they're running the bank internally in a recession-ready mode. And they pointed to the high quality of their credit books as defense. Like 85% of their card customers have FICO scores over 660. That disciplined lending provides a pretty big cushion if the economy does take a downturn.
All right, time for our This Is Not Financial Advice segment. Let's explore an outrageous but plausible trade idea based on everything we just heard. That huge RWA unlock, the ROTCE targets. What's the angle?
Okay, so the stock's trading pretty close to tangible book value right now. What that tells me is the market doesn't fully buy it yet. They don't fully believe Citi will hit that 10-11% ROTCE target and pull off the Banamex capital release smoothly and on time. That skepticism creates the potential opportunity. So the pitch, a long equity position, targeting, let's say, a $120 price point. That's roughly a 20% upside from where it is now. The whole idea is fueled by those two catalysts that we think are undervalued. One, achieving the efficiency gains they promised, and two, that massive capital boost coming from the Banamex RWA release.
So essentially, the bet is on management execution, especially getting that RWA freed up.
Precisely. That $37 billion in RWA, once it's fully released on deconsolidation, that translates directly into enormous future capacity. More buybacks, maybe accretive growth, stuff that's just sitting there, idle on the balance sheet right now. The $120 target depends on the market eventually waking up and pricing in that future capital efficiency, which right now they seem to be discounting. It's a setup for potentially a strong long-term payoff based on catalyst management is actually confirmed.
Okay, so to wrap up this quarter for Citi, a really powerful Q3. They raised guidance. They provided some tangible proof points for their strategic pivot record, institutional performance, strong consumer results, all backed by aggressive capital return. And those efficiency gains starting to really show up, fueled by AI.
Yeah, the macro picture is still murky, obviously. But it was interesting. They highlighted AI and data center investment as a key resilience driver for the U.S. economy, which leads to maybe a provocative thought. They saved 100,000 developer hours a week with AI already. Is that goal of getting the efficiency ratio below 60% by the end of 2026? Maybe you pick conservative now. How much more efficiency is already baked into their plans than they're letting on?
Something to definitely keep an eye on as we watch those efficiency numbers tick down. All right, thank you for joining us for this deep dive. We look forward to sharing more insights with you soon.